Okay, so I'm gonna get started. Hello, everyone. Thanks for coming. Feel free to interrupt me whenever, ask a question. I'm going to share my screen. I won't be able to see the chat, so um, just let me know if anyone has any questions. Okay. Okay. So deal or dud. So this webinar is how to analyze a property, and we're going to specifically be looking at a short-term rental property in Teller County. And first I'll go through a little bit of a background about myself, and then what makes a good deal, talk about goals, and then we'll dive into performa and all that fun stuff. So a little bit about myself. I'm Erin. I'm one of the agents on the team at Good Neighbor Realty, and I'm a real estate investor myself. I have purchased 5 properties total, 4 in Colorado specifically, and we currently have three of those properties. So we've sold 2, but now my strategy is to continue building my portfolio and try not to sell ever again. But my husband and I, we've done the, house hack burster method. So we've purchased all of our homes, primary residences, 5% down, and we've renovated them. So we've done the BRRRR, buy, rehab, rent, refinance, repeat. But then we turn them into a short-term rental and we move out of them. So then we don't have to move any of our furniture. We just leave all of our furniture there. So it's been really good. But now we have a 1.5-year-old baby or toddler. So I don't think we'll be doing a ton of moving around anymore. But I'm also a real estate agent. Like I said, I specialize in helping people find investment properties around Colorado, specifically short-term rentals because they cash flow. And I'm really passionate about what I do. So what makes a deal or a dud? So the biggest thing to look at is the input. So making sure you have accurate projections, accurate expense projections and revenue projections, and then figuring out if it aligns with your goals. And number one is really getting clear on your goals. I've made the mistake for our personal property sometimes is like we have too broad of an idea of what we want. We haven't gotten, very focused, and then we end up buying something that maybe takes a lot of our time where we didn't want to put too much time in, or maybe it takes a lot of money, whereas we wanted something more turnkey. So I would say number one, get clear on your goals. So do you want to cash flow, or do you want a vacation home that will break even, that your family can use for vacation? Do you want appreciation potential? So maybe the purchase price is going to be higher, and maybe the cash flow is a little bit lower, but then it's going to appreciate a lot. And then also location. So do you want a ski area? Do you want metro property so you can pop in and check on it whenever? Okay. Oh, hold on. Also risk tolerance. So what is the price point that makes you feel comfortable with your mortgage? If it takes a couple months to set up, are you comfortable covering that mortgage until it's up and running? Are you okay with a highly seasonal market? Also, get clear on the regulations, and that's something that I will help with, is making sure that the regulation, if you're buying a short-term rental, making sure that the regulations are friendly, or if there's licenses, making sure that you can get a license. And then also personal time commitment. Do you want a fixer-upper? Do you want a turnkey property? How much time are you willing to devote to this property? How far is it from your primary residence? Are you the type of person that wants to check in on it, between every between every turnover? If it's 3 hours away, like that's probably not realistic for you to drive 3 hours and check on it every single turnover. Also, are you self-managing it? Are you hiring a property management company? Are you looking to take advantage of the tax savings with bonus depreciation? If you are, then you need to get clear on those requirements, and you have to self-manage. You can't hire a property management company for those tax benefits. So really figure out what's going to work for you. Okay, so I have a 1-minute sanity check. So before we dive into all the details, because doing a pro forma is going to take a long time if you do it yourself, I like to quickly evaluate properties on the market with this rule that I created. So it's basically 13% of the gross profit margin rule. So it's 13% or more. So for example, here is a house in a 5-bedroom in Arvada, and it's $869,000 purchase price. So I know that a 5-bedroom in Arvada can make, if it has a hot tub, it's designed really well, it can make $120,000 a year in gross revenue. So what you can do is take that gross revenue, so $120,000, divided by the purchase price of the property that you're looking at, so $869,000, you get 13.8%. So that means that if you're higher than 13%, then that's a good deal in my head. And it's worth going down the path of putting all the inputs and numbers into a pro forma and then continuing to analyze. If you do this quick math and figure out that, maybe it's 5% or 2%, like it's not even worth spending another minute on this property if you want to make money with a short-term rental. Okay, so common items to look out for. So when you're buying a short-term rental, you have to make sure that some of these items, like you're looking at these items. So the roof age, HVAC age, siding, does the siding need to be replaced? How is the electrical panel? Does that need to be replaced? How's the sewer line? Do you have a place to put a hot tub? Like, is that property on a really steep grade in the mountains and there's no place to put a hot tub? A lot of these items will cost, at least $5,000 to fix at the minimum. So it's really important to make sure you're looking at everything when evaluating a property. Whoops. Also, the driveway pitch. There's been a lot of mountain properties that I've looked at that are impossible, have like an impossibly high pitched or really steep pitched driveway. And you know that someone coming from Texas with a 2-wheel drive car who's going to stay at your property won't be able to get up that driveway. Like that is an instant deal breaker for me. And I tell my clients not to buy that property if it has a really, really high driveway pitch, or steep driveway pitch. And then also location. So there's a lot of mountain properties that you have to take dirt roads to get to the property. And if it's 15 minutes away or more on like a really bumpy dirt road that someone with a 2-wheel drive car is going to have trouble driving on, then you should probably reconsider or just think about that, because not only are guests trying to get to your property, but cleaners, and are they going to want to go to your property? Are you going to be able to find like handymen and other tradespeople to come to your property? Another thing that a lot of people forget to look at is the septic size. So, like for example, Park County, they they limit the short-term rental occupancy based on the septic size of the property. So if you're buying a 4-bedroom house in Bailey in Park County and you want to rent out to 12 people, you've run your numbers based on 12 people. If the septic size is only rated for a 3-bedroom, you can only rent it legally to 6 people. It's 2 people per bedroom. So definitely take a look at septic size when you're evaluating mountain properties. If you have to upgrade the septic, it's going to be about $50,000. And some people are okay going into a property knowing that they'll just upgrade the septic size, but just make sure that you factor that into your numbers. And then deck condition. So a lot of people forget that decks cost a lot of money, especially if there's, multiple, if the deck's really high off the ground, if there's multiple levels to it. If the deck needs to be replaced, that's going to be a really, really big expense. And if you find out that the deck needs to be replaced and you're already under contract, that's something that, or any of these things, like if you find out that the roof age is like really old, needs to be replaced, that's something that we can negotiate while we're under contract and get seller concessions to pay, or for the seller to pay to replace these things. But that's just something to look out for. And then views, you want to make sure that a mountain property has views or at least privacy. And it's not next to hoarder neighbors, and it's going to be a bad experience for guests if that's the case. Okay, so metro properties. You want to make sure that your backyard, if you have a backyard space for guests, you want to make sure it's private. You don't want neighbors to be looking in to your guests or your guests looking over to your neighbors. Put up some privacy panels or trees, or just find a different property if it's not going to work. You want to make sure it's a convenient location. And because the Denver County and Denver City are so strict with short-term rentals, a lot of guests are renting in the surrounding areas like Westminster, Wheat Ridge, Arvada. So a lot of some newer investors will question like, well, why would someone want to rent a property in Wheat Ridge, Colorado? Like wouldn't you want to buy in Denver? Wheat Ridge is so close to Denver, and it's a lot better for regulations, and it's still convenient to everything. So you just want to make sure that within the Denver metro location, you're picking a place that has a convenient location close to most everything that people want to do, like go to Red Rocks or drive to the mountains. Also, parking, you want to make sure that you have ample parking for your guests. And then air conditioning is a big one. There's a ton of older homes in the Denver metro area that don't have air conditioning. So you want to make sure that you factor that into your numbers of whether adding an air conditioning system, or if it's an old house without vents, you'll probably have to do mini splits per room, and that adds up. So just something to note, air conditioning's pretty like a non-negotiable for guests in the summer in the metro area. Okay, so we're gonna go over this deal. It was just one of the homes that one of my clients had looked at in Teller County, and I thought it was a good example for today's webinar. So this is in Divide. It's in Teller County, which is west of Colorado Springs. And this house has views of Pikes Peak, really beautiful, looks pretty new inside, 3 bedrooms, 3 baths, over 2,000 square feet. and it's 534,000. Okay, so here's an example of a pro forma that I can help run numbers for any single property that you're interested in. And I'm just gonna I have like zoomed in parts of this pro forma for this presentation, just so you guys can easily see all of the inputs. So I start with the inputs, like the purchase price of the property, the down payment that you're planning on doing. So if you're doing a second home loan or a vacation home loan, you can do as little as 10% down. Most investment properties, you'll have to put at least 20% down. The interest rate, so if you're talking with a lender and you are pre-qualified, then you can put down your interest rate that you have talked with your lender about. Taxes, make sure that you look up what taxes are annually on the property. And then also insurance. So insurance is something that has increased significantly over the last year in all of Colorado. I personally like to estimate insurance higher than I think it's going to be. A lot of mountain properties will come in higher, and sometimes you have to reach out to 5 to 10 different insurance agents to even get a policy in the mountains, but just know that that's pretty normal for mountain properties, and it shouldn't scare you as long as they'll insure you, but the insurance annual premium might be a little bit higher than you expect. So I always recommend analyzing or putting a higher number than you think. And then based on number of bedrooms and how fixed up the property is, you can put in the bedrooms, how much you expect to pay for furnishing. We always tell people $10K per bedroom is what you can kind of expect for furnishing. That includes all dishes, everything that you'll need for the property. And that sounds like a lot. Everything adds up really quickly. And if you're the type of person who loves Facebook Marketplace, yeah, you can get a deal. You're going to spend a lot of time driving around, finding and picking up your deals. But I, again, like to estimate high. You can always reduce this number later on with actual numbers of furnishing. Okay, and then designer fees. So designers are for a 3-bedroom house, they're going to probably run you around $6,000 to $6,500. We have a whole list of designers that we can recommend, and you can get quotes from them. They also help buy the items that you're putting in your property, and then if you want to pay for someone to set up those items, that's what we call furniture install fee. So that's generally going to run around like 5,000 to 6,000 for like a 3 to 4 bedroom house. And then amenities. So hot tub is going to run at least $9,000. It depends on what type of hot tub you get, or if you want to put like hot tub and sauna or a hot tub sauna game room, whatever amenities you're planning on putting, you can put into this startup cost area. And then if the property is going to need any sort of renovations, startup costs, we also have a box for that. And I haven't seen any property that doesn't have at least like some sort of startup cost, whether you want to paint it or put up wallpaper. So I always like to put at least 5,000 in there. Okay, so next we add the projected revenue. So I'll go quickly over this. It's a lot more nuanced. This could be its own webinar of like how I project revenue on AirDNA, but I'll just go briefly over this. So this house is in Divide, so you can either search the address on AirDNA or you can just search the whole market. And a lot of times if you search the address, it's going to pull in a lot of comps that maybe aren't rented full time or don't have great design or maybe aren't as similar as you want to make your property. So I like to just look at all of the properties in the market and then see what's going to be as close as possible to the property that I'm analyzing. And I go into AirDNA and filter by number of bedrooms and then bathrooms and then how many people it accommodates. That way, if you're looking at a 3-bedroom house, you're not pulling in 6-bedroom homes or 1-bedroom homes. You're really filtering based on similar properties. So it will pull up different properties in the area, and it will start with like highest revenue down to lowest revenue. And I mean, unless the client tells me that they're going to go all out, they're going to spend, tons of money on a designer and all the amenities, I usually don't look at the first property that pulls up the highest revenue property, because that is the outlier most of the time. And I'd rather, over under promise and over deliver. So I like to be a little bit more conservative in like my estimates for revenue. So I usually don't even look at like the highest property in that area, but I start at, number 2 property and beyond. And I look to see how many people that property is sleeping. So these yellow arrows you can see point out to how many people that property sleeps. In Teller County, there's no occupancy requirement on septic systems, just like, Park County has, or similar to Park County has a occupancy cap. Teller doesn't, so you don't have to worry about that for this property. And then you can see like this number 2 property is making 109,000 a year in gross revenue. You can see the occupancy is 76%. The daily rate is $393. It is rented 365 days. So this is a full-time short-term rental. And it's similar to my property I'm looking at. It's 3-bedroom, 3-bath, sleeps 10. So like this is probably in my head, their highest that they could probably hit. If they copy everything and they're up and running for a little bit, then they could probably hit this same 110,000 gross revenue. And then I keep looking down this list and seeing what these other properties are making. So this one's making 102,000, similar occupancy, pretty similar average daily rate. It's a little bit less. This one is, you can see they're charging a higher daily rate, so $404, and their occupancy is less. So generally when you charge a higher daily rate, your occupancy is going to be less than when you're charging a lower daily rate. You'll get, more turnovers and more people in there and a higher occupancy. But you can see like this revenue is pretty close to this one. So it all kind of depends on like what you want as well. Like if you would rather set a higher average daily rate and then lower occupancy, so there's less times, like less turnovers, your revenue is going to be pretty similar, so it doesn't really matter. And then these ones, 90,000, 87,000. So we feel pretty good between 87,000 to 110,000. Okay, I'll stop right here. Any questions so far?
Hey Aaron, I have a question about the daily rate. Is that like before, uh, like that doesn't include any of the, because you know how Airbnb, when you choose the rate and then like as a guest, and then afterwards it'll add like all these fees and then cleaning. So is that the daily rate that it wants you to list, on Airbnb like before all of those other fees?
That's a really good question. I'm glad you asked that, because this number for AirDNA will include the cleaning fees wrapped into it. So just know that these numbers are a little bit inflated for what these people are actually charging. That's why I like to go by total revenue, and I'll talk about that in a second. And like in my performa, you'll see that like if I have around 100K revenue as the projection, like the average daily rate will be a little bit less than this to actually calculate this number. So that's a really good question. So like the occupancy is pretty accurate, but this daily rate has all like the cleaning fees and everything built into it. So in my pro forma, we'll back out all of that so you can see cash flow. But that's a really good question.
Okay, thank you.
Yeah. Anything else at this point?
Does that revenue include the cleaning fee and all that as well?
Correct. Yeah,
Okay.
it
So
does.
if you were cleaning it yourself, then that would be a expense that you're.
Just said that.
Oh, nice.
Yeah, so if you're cleaning yourself, and I can show you how to set the performa to like like if you're cleaning yourself, how you can figure out what that means for you in terms of cash flow and stuff like that. Cool. Okay, so here is our annual gross revenue number with cleaning. So for this house, I'm going to go low on projections for annual revenue. So like you can see here, the like lower two are around 90,000. So I'm just putting around 90,000 here. And I can play around with this average nightly rate and occupancy to get this number to 90,000. So you can see here my average nightly rate is 285 with a 70% occupancy, and 285 is like a little bit lower than this, and lower than this one. And then we have like a little bit lower occupancy. So a lot of people kind of get caught up in, oh my gosh, what's my average nightly rate? Oh my gosh, what's my occupancy? But if the market average is about 65% in average occupancy, I know that if you're going to use a designer and have nice furniture, you're probably going to be above that. And then I play around with this average nightly rate so that my annual gross number is as close to the comps that I want to shoot for as possible. So this includes the cleaning fees. And then if you back out the cleaning fees, it's the $72,000 number. So in here, I have the cleaning fee per reservation and then the cleans per month. So about 70% occupancy, you'll have 6 cleans per month. And if the cleaners are charging you about $250 to clean, that monthly pass-through cleaning is $1,500, or $18,000 a year, which isn't, so we back that number out of this annual gross revenue number so that you could see what your monthly cash flow number is, and I'll get to that part in a second. But if you are doing your own cleans, like Steve had suggested, you can just put 0 here, and then that will increase your cash flow number if you're cleaning yourself. I think that's everything on that. Does anyone have any questions on this? Okay. Okay, so then I like to dial in my expenses. So I already talked about the cleaning expenses and cleans per month, all of that fun stuff. Then you want to talk about, or then you want to put in, like, if there's an HOA, a lot of the mountain homes will have a very small HOA, like $10 a month or $5 a month. And that's for keeping the roads clean, plowing dirt roads in that neighborhood during the winter, most likely, or if there's like a pond that they stock with fish or, whatever it may have. You want to make sure that for the property that you're looking at, if it's a Denver Metro property, you don't want to have an HOA because most of the time the HOAs can change. If they're friendly right now towards short-term rentals, they can change their laws and regulations and then not allow short-term rentals later, and then you're screwed if that's your strategy. But you can't really get around HOAs in the mountains. For most of the mountain properties, will have like a really small HOA. So gas, electric, internet, water, septic, sewer. So if there's a well, you won't have to pay for your water. And then if it's a septic tank, you have to pump it, once every couple years, depending on how big that septic tank is. And pumping is generally around $600 a year. So you can just create the monthly or put in the monthly expense here, even though it's going to be like a one-time fee of $600. And then we have capital expenditures. We estimate 3%. So that's to save up for new roof, new water heater, whatever you're saving up for in case, if something goes bad or you have to fix it in the property. And then snow removal. We have snow removal expenses, pest control, hot tub is generally $250 a month. And then your property management system. So hospitable, guesty, if you have auto pricing like Price Labs. And then I guess I skipped over property management. So generally, if you're looking to get into short-term rentals for the bonus depreciation, like tax, I don't want to say loophole, but the tax benefits of using bonus depreciation against your normal income and saving your, how much you pay in income every year, you can't use a property manager. So we normally just put 0%. But if you're planning on doing a property manager, you can expect probably anywhere from 18% to 20% for a short-term rental. And just know that's a little bit hard to cash flow right now with a property manager at today's interest rate. So if you do add that expense in, just know it will kill your cash flow, and that's totally normal when you add a property manager in. Okay, so now we get to analyze. So this property, the cap rate is 9.5%. So the cap rate is essentially your net operating income divided by the purchase price of the property. So net operating income is your income minus all of your expenses, and it doesn't include your mortgage fees or anything related to financing, because you want to be able to analyze properties without like comparing the financing and having everything apples to apples. So net operating income doesn't include anything with financing. A normal long-term rental in Denver area will be around 5% cap rate. So anything higher than that is going to be a better deal in terms of higher cash flow and returns on your investment. Generally, I like to see if there's a short-term rental that's at least 8% or more in cap rate. I would say, depending on your goals, like it's probably worth looking into that. This is close to 10%, so it's pretty good in my eyes. And then the cash flow per month is around $1,000. Just know that this cash flow number backs out the capital expenditures. So your actual cash flow is going to be a little bit higher, but we have the 3% capital expenditures built into there. So that subtracts that number. And then our pro forma, we've gotten really nerdy this year with like 1-year financial benefits, 5-year financial benefits, 10-year financial benefits. So we include the principal pay down, the appreciation, the tax savings, if you're doing bonus depreciation, tax savings, all of that fun stuff. And then we have the number of the total cash invested right here. So like you can see how much you're going to spend between down payment, renovations on the property, if any, furniture, designer, furniture install fee. And then in this like passive financial benefits section, so it uses the appreciation that we have in the pro forma to calculate this number. And generally in like Colorado, Front Range and mountain regions, the average is about 5% a year in appreciation. And if you want to get like pretty granular, like if you, let's say you're investing in Breckenridge and you want to actually have the correct annual appreciation on there, I can pull that number for you and edit this so that, you know, you can see exactly how much in appreciation you're going to be making every year. And then finally, the bonus depreciation. So that's the tax benefits that I talked about. So now, whoops, it used to be at 40% this year. Now it's been bumped up to 100%. So this number is actually, this tax savings number is actually going to be higher because it's 40% of this total instead of 100% of this total. But you can put in your tax bracket percent and see actually how much you're going to save in tax savings if you manage the property yourself. So it's a lot of numbers and a lot of explanation, but any questions on this part? Oh wait, one more thing I wanted to add. I forgot to talk about cash on cash return. This is dependent on how much cash you put into the property. So if you're buying it as a second home or a vacation home and you're putting 10% down on the property, your cash on cash number your percentage will be a lot higher and it'll show a better deal than if you put 20% down or more on the property. But then on the other side of the coin, if you put more down on the property, your cash flow number is going to look a lot higher every month. So just know that these numbers are very dependent on what you decide to do in terms of down payment, and all that fun stuff. Okay. Okay, what do you guys think? Would you buy this property as a short-term rental? Is it a deal or a dud? There's no right answer, no right or wrong answer, but I'm just curious. Anyone want to answer? No. Alyssa, I'm gonna call on you.
I'm gonna say it's a deal if I was looking for a mountain property.
Good answer. I like that. Yeah, and it depends on anyone's goals. Like, let's say someone really wanted a property in this area and they wanted to cash flow, like, yeah, this would be a great property for them. Okay, so I'm just gonna go into really quick about, that's the end of our performa analyzing. So I'll go into about Good Neighbor Realty a little bit, and then we'll be done. I'll open it up for questions. So if you guys don't know about Good Neighbor Realty, so we're a full service brokerage firm, and a lot of other companies will charge $10,000, $15,000. Like STR Insights will charge like $15,000 to find someone a good short-term rental property. We don't charge anything extra for our like finding you a good property. I get paid from the sellers of the property that you buy, like a normal real estate agent. So you could say that all of these extra extra things that I provide are essentially free. But we have events. So if you've never been to any of our Good Neighbor events, they're really fun. So every month we have Airbnb happy hour where we go to one of our clients' active Airbnb short-term rentals and they talk about how much they're making and like what it was like to buy the property and set it up and what they've learned. So those are really fun. We have a short-term rental pro course, which you get for free if you purchase a property with us. Or you could purchase it and then get refunded after you close on a property. I provide investment property underwriting, so looking at performas like this. We have a podcast. We have AirDNA access, which is what I use to estimate the revenue. And then we have a whole list of different short-term rental specific contractors by area. And not only do I help find a property and underwrite it, I'll help you develop your strategy. I'll navigate legislation. I'm very aware of legislation around the state of Colorado. So if you want to invest somewhere else outside the Denver metro area, I can help you with that. I talked about property analysis, but once we decide on a property and secure it, I help navigate inspections and negotiate in terms of, if there's something wrong, I can help get the seller to pay for that. And then I have all the tools to help you be a top performer. All of our clients are in the top 10% of short-term rentals around Colorado. We have all of our designer contacts. We have all of our preferred vendors and contractor contacts. And then also we can help with helping you figure out, how you automate it, how you set up the property, or if you have any questions, I'm more than happy to answer them. So here is our course, our short-term rental pro course. If you use my code and buy the course, it's $500. It will go into everything like how to get ready to buy a short-term rental, purchase it, set it up, and then be successful. And then again, if you close on a property with Good Neighbor Realty, you get refunded. So if you're that type of person who wants to learn before pulling the trigger on anything, this is a good way to do that. And then here's all my information. If you have any questions or if you want to start your short-term rental search in Colorado, my number is there and you can book a call with me or follow me on Instagram. But yeah, any questions?
Erin, I had 2 questions.
Mm-hmm.
You had mentioned ACs in Denver metro properties. It's a necessity, but is it not as much of an issue in mountain properties?
Oh yeah, that's a good question. So a lot of mountain properties won't have AC, and it's not as much of an issue with a mountain property. Most people can just open a window and be fine sleeping at night. But if you have a mountain property that is multiple stories and there's one, on the second story that it gets pretty hot, you kind of have to play that by ear, and you might have to put in like a window unit or a mini split upstairs in the mountain property. But yeah, most of the
Gotcha.
time, mountain properties won't have AC as well.
Okay. And then I was wondering, would we be able to get that spreadsheet so we can plug in our own numbers if we're looking at Airbnb?
Yeah,
or
I can send
properties?
it. So,
Okay.
yeah, if you just send me an email, here, I'll take a picture of your name spreadsheet. But if anyone else wants the spreadsheet, just feel free to send me an email, Erin@thegoodneighbors.com, and I can send it to you.
Cool.
Yeah.
And the recording will be sent out with everyone who signed up through Eventbrite, right?
Yes, I can send that out. Generally, I don't think we send out the recordings, but I'll send it out to everyone.
Thanks.
Yeah. Okay. Who's ready to buy a short-term rental? No one? Okay. Cool. Well, any other questions? Great. Well, thank you everyone for joining today. I hope you learned something. Take care.
Thank you.
Thank you.